Hello and welcome. You are watching First Stick here on News9, where we bring to you the morning buzz on the Lal Street. I am Suyash Maheshwari, and with me in the studio is Amit Ranjan. Now, we have lots to talk about on today's show. The Reserve Bank of India will announce its monetary policy outcome today. Now, this will be the first policy decision of calendar year 2024 and the last one of financial year 2024. Now, the broader expectation is that they will keep the repo rates unchanged. Now, the repo rates has been consistently held at 6.5% since February of 2023. Brokerage firm Nuvama expects RBI to indicate the end of tightening, however, much like the US Fed, by softening its stance. Although it does not think the MPC would be in a rush to lower guidance as of now. Because the entire problem why they would not go for a policy cut is that India's headline CPI is still elevated, and that is led by food, and the Fed is still on hold, remember. Apart from the policy outcome, the focus will also be on the central bank's commentary on a host of issues, including the current macroeconomic factors as well as the crisis that's going on with Paytm. Remember, we are also in the midst of the December quarter earnings season, and today Nifty constituents, Grasim Industries and Apollo Hospitals will announce a number. Also, LIC, Zomato and Patanjali Foods will be reporting their numbers as well. Furthermore, today is the weekly FNO expiry for Nifty, so expect a choppy Thursday today. But overall, the markets has opened higher. In fact, Nifty has opened above the 22,000 mark for the second day on the trot. On Wednesday, however, we failed, we opened above 22,000 but failed to sustain above that level, and Nifty corrected sharply from there on. We ended about 21,930 mark. Let's see if we can sustain above it today. I mean, the texture of the market seems to suggest so, but we have a lot of triggers, so the markets will be rather choppy today. The broader markets are also trading in the green. They are up over 0.5%. Nifty Midcap 100 is up 0.84% as of 9:30 a.m. this morning. The index has hit another record high. The small cap index has also hit another record high, and India VIX is trading slightly higher, up 0.2% at 15.54 levels. But with that, let's also bring on board Mr. Santosh Meena, Head of Research at Shweta Investment. Thank you for joining us on News9, Santosh. Always a pleasure seeing you. In the last 4 out of 5 sessions, Nifty has sharply fallen from their respective, intraday highs. But overall, the base has been slowly shifting upwards. Now, the index has been, of course, making higher bottoms. But what's your overall sense of the market, and can we sustain above 22,000 now this time around?
Yes, first of all, good morning. Yes, market in consolidation mode with a bullish bias. Generally, January, February has a tendency to be volatile, and that's why we are seeing some kind of volatility. And technically, 22,125 is acting as an immediate hurdle. The high was made in January, and again, same level is acting as a resistance. But bias is bullish because Nifty is respecting its 20-day moving average, which is currently around 21,700. So once it will cross 22,125 level, I'm expecting further bullish momentum towards 22,222 and 22,350. Even we can expect a 22,500 level in coming days. So until and unless Nifty trades above its 20-day moving average, which is around 21,680, the view will remain with a buy-on-dip structure. Yes, Nifty is volatile with both side trades in intraday, but there is a lot of action in specific stocks and sectors.
All right, and Nifty Bank, although it outperformed yesterday, I mean the outperformance wasn't really convincing now, because the index once again failed to close above the 46,000 mark. Also, most of the outperformance that we saw yesterday came from low float PSU banks, which rallied somewhere from 15 to 20%, and the big ones are just not contributing. So what's your overall assessment of Nifty Bank at this point in time, sir?
Yes, the problem with the bank nifty is it is a very lopsided index because major contributors are SDFC Bank and ICICI Bank, which are not performing. Actually, they are key triggers, especially SDFC Bank. And the PSU banks are outperforming, but they don't have much weight in bank nifty. But I believe bank nifty is trading at a critical juncture of 45,500, near 45,500. We have a 100-day moving average, and it is trying to make a base at this level. And I believe after a RBI policy, we can expect a short covering rally on immediate basis. 46,200 to 300 is a resistance zone, which is 20-day moving average. Once it will cross 46,300 level, we can expect a short covering rally towards 46,800, 47,000 mark. The reason is that one of the reason is that I'm expecting some dovish policy in this policy could be dovish up because after a fiscal number of 5.1%, and if that will be the case, then there will be chance of short covering rally in banking stocks. And if you see the weightage of banking stocks in Nifty, it is around 5-year low. So it also makes a case for a value buying in banking stock. But yes, SDFC Bank has to outperform. So today we have a UBS report. They have upgraded the stock for the target of 1900. So we can see some support. We can see recovery in SDFC Bank, but we will get support from like stocks like SBI, Axis Bank. So I'm expecting outperformance in Bank Nifty from here.
All right, and of course, Nifty Bank will be in focus considering that we have RBI policy outcome today. But one of the stocks that has been performing is Yes Bank. It's up another 7% this morning. In the last 3 sessions, the stock has rallied by a whopping 39%, and the sharp rally, for the benefit of our viewers, comes after HDFC Bank Group said it has received approval from Reserve Bank of India to acquire up to 9.5% stake in 6 private lenders, including Yes Bank. Now, interestingly, Santosh, I read on Twitter that the market cap of Yes Bank, currently placed at around 90,000 crore, is higher than what it was when the stock was at rupees 375 back in 2018. I mean, interesting observation. And what are you making of this rally and this run up we are seeing in Yes Bank, sir?
Yes, if you look price, you will say stock is much cheaper compared to it was before NBFC crisis. But yes, there was too much equity dilution. So after that, at current level, market cap is higher and stocks looks expensive. So technically, we are seeing bullish momentum in small banks, PSU banks, and some private banks as well. And technically, there is a breakout of 25 resistance level. So I'm expecting some bullish momentum may continue for towards 40 kind of level. I would suggest better to exit from this stock if you get high level of 3640 level, because there are good opportunity in the market. There are lots of opportunity, so better to stick with the quality rather than volatile stocks.
Good morning, Santosh. Tata Consumer Products announced their Q3 results yesterday. The net profits fell by as much as 17.3%, missed estimates. Even us yesterday had predicted a fall of only 5.5%. Revenues are up over 9%. EBITDA is up 26%. Margins are up 200 basis points. Where did the profits get eaten up? I would like to find out from you. While international business is up 6%, India business is up 10%, non-branded business is up 4%, coffee has contributed 32% to the growth, Tata Sampann 40% to the growth, salt portfolio 23% to the growth. Probably they have added 22 new stores to Starbucks and 42 new stock keeping units. Probably that's eating up into the profits. Looking at the stock today, it is down as much as 1.82%, but still not too far from its 52-week high. Is it time to buy into this stock at this time, or should we wait, because it's still even at this low, not too far from its 52-week high?
Yes, I'm not fundamental expert, yes, but prima facie numbers looks weak on profitability front. But I think there was an exceptional item. That's why the profitability looks down. But technically, is in strong bullish momentum, and it is in a consolidation phase after a run up. I'm expecting this consolidation phase will lead to upside breakout, and we may see a fresh bullish momentum. So I think by this stock in this consolidation, you will have a well-defined stop loss of 1120, and once it will cross 1180 level, we can expect a further rally towards 1250 kind of level in coming days.
that's a view coming in from Mr. Santosh Meena. Sir, thank you for joining us here on News9. Always a pleasure speaking to you.
Thank you.
Now, Amit, we also, of course, have RBI policy meet. The governor, Mr. Shaktikanta Das, will start speaking in just a few minutes from now. But, Grasim, now that's going to report its Q3 numbers in today's trade. What are the expectations?
Thank you, Suyash. The flagship company of the Aditya Birla Group, the makers of Ultratech cement, and they are into almost everything, linen, yarn, chlor-alkali paints also. Revenue is expected to be up only 2.6%, coming in at 6,360 crores. Net profits are expected to go down by as much as 23.5%, coming in at 196.5 crores. EBITDA is expected to be up 22%, coming in at 582.7 crores. EBITDA margins too are expected to jump 150 basis points. So, but for net profits, which is likely to see a big fall, probably because of the expenditures in their new businesses and paints, they seem to be all right. I mean, big jump in EBITDA, increase in revenues, big jump in margins too.
All right, that's what the expectation on Grasim is. But, I'm looking at the markets. They are looking rather choppy ahead of the policy decision. Remember, it just comes out just in a short while from now. Mr. Shaktikanta Das will start speaking at 10 a.m. The expectation is that, so we'll get to it. We'll get to what the decision is and the post-decision analysis in just a bit from now. But the markets, Nifty is trading at the day's low, very close to at the day's low. It has fallen below the 22,000 mark. We are at around 21,975 as of 10 a.m. this morning. About 25 points shy of the 22,000 mark. The day's low currently sits at around 21,950. So, keep a track for the markets moving lower. And I think is the banking stocks, that will be in focus, of course, as was pointed out by Mr. Santosh Meena. The banking index is trading 0.5% higher in the morning, and we are holding above the 46,000 mark. Now, remember, the index has struggled sustaining above 46,000 in the last 1 month or so. Consistently, we have seen profit taking from those levels, and of course, policy decision will give some direction to the banking stocks. But as of 10 a.m. this morning, the banking index is trading higher. It is contributing to the early morning gains, and it's up 0.5% above 46,000 mark. Sensex is also trading about 0.2% higher. It's up 140 points, just closing in on the 72,300 mark. And your broader markets, now they continue to outperform. They both are up somewhere around 0.5% as of 10 a.m. this morning. And Nifty mid cap index and the small cap index, in fact, both of them have made a record high once again in today's trading session. For the last 14-15 sessions straight, I think there has been 12 or 13 instances where the mid cap index has made a high. Small cap index, on the other hand, Amit, is on a 10-day gaining streak, and that has been the strongest segment of the market. So watch out for that. It has also made a record high. We made a record high on the small cap index after a gap of about 2-3 sessions yesterday, and the index is building onto those levels. It's up about 0.5% this morning as of 10:10 a.m. Sitting just below the 16,650 mark. Volatility, remember, that continues to be a problem for the market. It is elevated, on a day-to-day basis. It's up 0.2%, but 15.54 is historically considered a high level of volatility for our markets. So keep an eye out for that. We, of course, have lots of macroeconomic events that are taking place. Of course, RBI decision that comes out today. Remember, the monetary policy outcome, it is a first policy decision of calendar year 2024 and the last one of fiscal 2024. And as far as the rate cut is concerned, the broader expectation is that the repo rates will be kept unchanged. They have been maintained at about 6.5% since Feb of 2023, and pretty much Mr. Das, through multiple media interactions, had also said that all right, Mr. Shaktikanta Das has started speaking.
Stands for stability, trust and economic progress. In recent years, it has become a pioneer in fostering innovation and technology in the financial system. Customer centricity and financial inclusion have always been its priorities. The Reserve Bank's tireless efforts towards maintaining a fine balance among price stability, financial stability, and external sector stability have paid rich dividends as the country embarks on a higher growth trajectory in the years to come. As India gains a pole position in the new global order, the contribution of the Reserve Bank is getting widely recognized both within and outside the country. The global economy continues to present a mixed picture. On the one hand, the odds of soft landing have increased, with inflation moving closer to the target and growth holding up better than expected in major advanced and emerging market economies. On the other hand, the ongoing wars and conflicts and the emergence of new flashpoints in different parts of the world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. The world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. In this unsettled global environment, the Indian economy has performed remarkably well in the recent years. Growth is accelerating and outpacing most of the forecasts, while inflation is on a downward trajectory. At the current juncture, India's potential growth is propelled by structural drivers like improving physical infrastructure, development of world-class digital and payments technology, ease of doing business, enhanced labor force participation, and improved quality of fiscal spending. Our multi-pronged, proactive and calibrated policies on the monetary, regulatory and supervisory fronts have worked well to maintain and strengthen macroeconomic and financial stability. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-to-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued across both goods and services, reflecting the cumulative impact of monetary policy actions as well as the significant softening in commodity prices. The uncertainties in food prices, however, continue to impinge on the trajectory of headline inflation. Taking into account this growth inflation dynamics and the fact that transmission of the cumulative 250 basis points policy rate hike is still underway, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will carefully monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations. I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect I think is an important aspect and it will impact the future trajectory of global financial stability and global financial system. So therefore this point I thought I must mention here as a part of the monetary policy statement. Now amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of future activity index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing, coupled with increased thrust on government capex, is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation, together with a rebound in agricultural activity, should push up household consumption. Rural demand continues to gather pace, strengthening farm level activity as reflected in declining Mahatma Gandhi Narega demand, and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat, and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22, that is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important, because if we are interested in the long term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained, but I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4%, and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way market interventions, both repo and now reverse repo, and we have been very nimble even during one particular day, like yesterday and day before. On a single day we conducted 2 VRR auctions on a single day. That was seen yesterday and day before, and that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves and return of capital flows. Now the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee has remained fairly stable over the last 1 year or so. I would now like to touch upon financial stability. The domestic financial system remains resilient with healthy balance sheets of banks and financial institutions. The financial parameters of non-banking financial companies, that is NBFCs, are also improving in tandem with those of the banking system. Good governance, robust risk management, sound compliance culture and protection of customers' interest are of paramount importance for the safety and stability of the financial institutions as well as that of individual financial institutions. The Reserve Bank lays great emphasis on these aspects. We expect the regulated entities of the Reserve Bank to accord the highest priority to these functions. External sector is the next area on which I would like to touch upon. India's current account deficit declined sharply to 1% of GDP in the second quarter of 2023-24, that is second quarter of the current financial year, from 3.8% in the second quarter of the previous year. Going ahead, the net balance under services and remittances is expected to remain in large surplus, partly offsetting the trade deficit. India's services exports remained resilient in October to December this year, driven by software, business and travel services. Moreover, with around 10.2% share in world telecommunications, computer and information services exports, India is a significant player in the world software business. According to the World Bank, with an estimated $135 billion inward remittances in 2024. I repeat, the World Bank estimates the inward remittances for India to be in the order of $135 billion in 2024. Now with this, India would remain the largest recipient of remittances globally. Thus, current account deficit for both 2023-24 and 24-25 is expected to be eminently manageable. On the financing side, net foreign direct investment stood at $13.5 billion in April to November 2023 as compared with $19.8 billion a year ago. Foreign portfolio investment, that is FPI investment, witnessed a sharp turnaround during 2023-24, that is current year up to February 6, with net FPI inflows of $32.4 billion as against net outflows of $6.7 billion a year ago. Net accretions to non-resident deposits and net inflows under external commercial borrowings were also higher during the current year. As on February 2, 2024, India's foreign exchange reserves stood at $622.5 billion. Vulnerability indicators suggest greater resilience of India's external sector. We are confident of comfortably meeting all our external financing requirements. I shall now announce certain additional measures, and some of these measures are very important, so I request your patience. The first measure I wish to announce is review of the regulatory framework for electronic trading platforms. The Reserve Bank's extant regulatory framework for electronic trading platforms was issued in 2018. In view of the subsequent developments in markets, products and technology, etc., a revised regulatory framework for these electronic trading platforms will be issued for stakeholders' feedback. The next announcement relates to hedging of gold price risk in the OTC market, that is over the counter market in the International Financial Services Center, IFSC. In December 2022, the Reserve Bank had permitted resident entities to hedge their gold price risk in recognized exchanges in the IFSC. It has now been decided to allow resident entities to hedge the price of gold. Now let me rephrase, let me just read it again. It has now been decided to also allow resident entities to hedge the price of gold in the OTC segment in the IFSC. This will provide more flexibility to resident entities in hedging their exposure to gold prices. The next announcement is actually very important and has far-reaching consequences. Particularly, it is something which will really benefit the small borrowers from the from the lending sector, from banks and other entities. At present, and that relates to key fact statement, that is KFS for retail and MSME loans and advances. At present, the loans and advances availed by borrowers, apart from including the rate of interest, also include other fees and charges such as the processing fees, documentation charges, etc. So as a result, what happens is that the customer, he knows that the loan carries an interest of so much percentage, but then there are other charges and fees, etc., which he pays upfront. Now that also needs to be loaded into the actual interest rate. So the customer has a clear idea that what is the actual annualized interest rate that he pays. And this is something on which, as you are aware, as I have said a little earlier, customer centricity is something on which the Reserve Bank lays a great emphasis in the overall public interest. Now, to enhance transparency in disclosure of such information, that is information on various charges, fees, etc., the Reserve Bank had mandated certain categories of lenders to provide the borrower a key fact statement, that is KFS, containing essential information such as all-inclusive annual percentage rate and recovery, and also details of the recovery and grievance redress mechanism. The requirement of the key fact statement is now being extended to cover all retail and MSME loans. This measure will lead to enhanced transparency in making informed decisions. The circular will be issued separately. Obviously, we have to give some time to the banks to comply with these requirements, because quite a few preparatory action needs to be taken at the end of the banks. The next announcement relates to enhancing the robustness of AEPS. Aadhaar enabled payment systems, that is AEPS, has played an important role in financial inclusion by enabling customers to make digital payment transactions through service providers such as business correspondents. Given their significance, it is proposed to streamline the process for onboarding of AEPS service providers and introduce some additional fraud risk management measures. This measure will further strengthen the security of the AEPS system and enhance its robustness. The next announcement relates to principle-based framework for authentication of digital payment transactions. Over the years, the Reserve Bank has proactively facilitated introduction of various mechanisms such as additional factor of authentication for securing digital payments. While no particular mechanism was specified by the Reserve Bank, SMS-based OTP, that is one-time password, has become very popular. With technological advancements, however, alternative authentication mechanisms have emerged in recent years. Therefore, to facilitate adoption of alternative authentication mechanisms for enhancing the security of digital payments, it is proposed to put in place a principle-based framework for authentication of such transactions. The next and the final announcement, the last announcement, relates to introduction of programmability and offline functionality in central bank digital currency pilot projects. The CBDC, that is central bank digital currency retail, the CBDC retail pilot currently enables person-to-person and person-to-merchant transactions. It is now proposed to enable additional functionalities of programmability and offline capability in CBDC retail payments. Programmability will facilitate transactions for specific or targeted purposes, while offline functionality will enable these transactions in areas with poor or limited internet connectivity. I now propose to conclude. The Indian economy is making confident progress on a strong, sustained and transformative growth path. Domestic and international investors are reposing greater confidence on India's economic prospects. In our assessment, the current setting of monetary policy is moving in the right direction, with growth holding firm and inflation trending down to the target. Therefore, much has been achieved, but we must remain vigilant. Policy making during uncertain times has to be based on a continuous assessment of the incoming data and its implications for the evolving outlook. We reaffirm our commitment to bring down inflation to the target of 4% in a timely and sustainable manner. Price and financial stability are the foundations for strong, sustainable and inclusive growth. Our endeavor all along has been to take a holistic approach to keep the economy in balance. We must not only preserve the hard-earned strength and stability of the Indian economy, but also build on this further for a long haul of higher growth with price and financial stability.
And that is, of course, RBI Governor Shaktikanta Das on the back of the monetary policy decisions that have been taken in the past 3 days. The big headline, of course, is that the stance remains withdrawal of accommodation and the rates, the repo rates are unchanged, Kartik. That, of course, is the big takeaway from that monetary policy decisions. It is a very crucial, exciting time for the Indian economy, of course, because on the back of all the announcements made, I think Governor is firm on the growth path that India has ahead for itself. Yeah. And of course, there's no need for change just as yet, given the global pressures that global economies continue to face.
Absolutely. So I think, in addition to the India story, and let's just reiterate the India story that Shaktikanta Das, the RBI governor, mentioned. So we are looking at repo rate being unchanged at 6.5%. We are looking at headline inflation to average out at 5.4% for financial year 24, the financial year that we are in. We are looking at the call rate to be fixed at 6.75%. And in addition to that, there is likely to be a global improvement in growth. There is likely to be a global tapering of inflation going ahead, but global headwinds continue to command India's inflation. And at the same time, the volatility in food prices, which are linked to, at one end, the global crisis, at the other end, the monsoon, is something that the RBI governor is watchful of.
Absolutely. And let's quickly also get in Vivek Kumar, economist at QuantEco, joining us on the show. Vivek, thank you very much for taking time out. Good to have you on the show. What, according to you, were the big takeaways from this MPC?
Hi, good morning. Good to be back. So I guess it's completely along expected lines with respect to the decision on interest rate as well as the policy stance. It's not just a vote for status quo. I think it's also a vote for confidence in the economy, because you've heard him say that they're expecting 7% GDP growth. Not many countries in the world at this point in time are projecting that kind of a growth number. I think more importantly, 7% GDP growth is getting accompanied by a slight amount of disinflation from somewhere close to 5.3% in the current financial year to 4.5% in next financial year. So while growth is almost, you could argue, steady at 7% handle, inflation is moderating. So that's a vote of confidence, and he did not just stop at the growth inflation balance. He also pointed out some of the strengths in India's external sector, both on the current account, which is the trade side, as well as on the services side. And while also taking pains to highlight that financing of the current account deficit is not a concern for India as such. So it's a vote for confidence. And I think the key message is the preservation of macro financial stability, which the RBI has made every attempt in the last 12 months to preserve. And going forward, that will be the primary goal.
Okay. In addition to that, Shweta, I think what has also caught my attention has been this review of e-trading platforms, which Shaktikanta Das just mentioned. So what is this review going to entail is going to be something that we should be watchful of. Are we going to see the trading platforms like Zerodha, Grow, etc. face more strict action from the RBI like we've seen in the fintech space? I think that is something that is going to emerge going forward. In addition to that, I think what has been a positive this time around has been the fact that RBI governor has also said that the transparency in the key fact sheet, key fact statements that was asked for and hinted upon earlier, that is also likely to become strengthened now. So RBI governor wants to include all the processing fees, all the one-time fees, all the retail MSME loans to be included in the loans and advances. But overall, I think the interest rate should be inclusive of all the other fees that go into, what the end consumer actually pays to banks, to be included as part of the interest rate. I think these are important takeaways for the consumer at the end.
All right, absolutely. And since we are on important takeaways, let's go after them one by one. Vivek, firstly on the growth path at 7.3%, RBI governor reinstating that is going to be the growth trajectory for India. But also talking about headline inflation, he hinted at how, a lot of things that are not in government's control, and one of them could be the adverse economic impact of what comes by the way of a weather condition in India. What are you making of inflation in the month of January? Because we don't have the numbers for January just as yet. We do know that the average inflation that RBI and the government is accounting for would be to the tune of 5.4% in this entire year.
Yes, that's for the year. For the quarter that we are in currently, the projections were revised lower. So in the December policy review, the Q4, which is Jan-March quarter CPI inflation, was at 5.2%. It got revised lower to 5%. So that gives you a sense that vis-a-vis what RBI expected 2 months back, inflationary pressures are somewhat lower as far as this current quarter is concerned. And your broader point of 4.5%, and along with the risks that he highlighted, I think it's important to keep in mind, while yes, the trajectory of inflation is comforting. You're coming down from 5.3, 5.4% to 4.5% next year. There are, ample amount of risks which could spoil the party. And that clearly shows the vigilance and the caution in his statement, as well as the overall MPC's statement, which I'm assuming would be up on the website any moment now, that even with a 4.5% inflation, which is quite comforting, the governor and the RBI, they are not ready to let their guard down yet, precisely because there are enough risks on the horizon, and you want to sail past those risks comfortably.
So Vivek, does it mean that the higher for longer narrative is going to continue in India even till perhaps the end of this year? Because there were expectations that in Q1 of the next financial year, we might see some sort of a tapering of interest rates. But if headline inflation is unlikely to come below the 4.5% mark for all of FY25, then can we expect a rate cut anytime in the next financial year at all?
So that's something which the market participants are trying to place the bets on. I'll deviate a little bit from the narrative of higher for longer, Kartik, and probably use the term steady for longer, because RBI has been steady since February of last year, both in terms of interest rates as well as in terms of its monetary policy stance. Now, as far as when do they pivot from their steady stance, we believe that it's probably going to happen after a gap of 6 months. Okay. And our rate cut expectations is starting from the month of October. So October, December, and February, which is the second half of the financial year, we could possibly see a cumulative rate cut of up to 75 basis points. So basically 25 basis points rate cut each. Okay. Now, why we are saying that we need to wait for 6 more months, 6 to 7 more months? One, we'll have clarity on food prices. We'll have clarity on monsoon, some of these risks that RBI has highlighted in a very distinct manner. Two, we'll have the full-fledged budget by then. So in June or max by July, you'll have the full-fledged budget. And three, the Red Sea disturbance and the trade costs that could potentially increase, which the governor also highlighted. We will also get some sense as to whether the things are persisting on the geopolitical front in that manner, and is it leading to any pass-through in terms of import price pressures. So next 6 months, I guess you'll have a lot of answers to some of these risks that the governor highlighted. Okay. And it makes sense to wait out because, you've done the hard work. As he himself said that, it's all about the last mile connectivity now. So we've almost done 4/5 of the journey. This is the last bit of the journey.
Disinflation.
Right. Yeah. You need to make sure that you win. You come home, with a winner's flag rather than, lose whatever amount of gains that you've gathered in the past 12 months.
I have two questions for you at this point, and I would like to begin with the public debt that RBI governor referred to. He, of course, was referring to the IMF report suggesting that public debt in many developed and developing economies could touch 100% of the GDP. IMF also flagged risks for India, where public debt, both centre and states combined, is at 57% of the GDP. How concerned are you about the public debt that India has on its books right now?
So, debt is something which is both a relative game as well as an absolute game. So when you're comparing India vis-a-vis, let's say, other countries, I guess it's the picture will not be absolutely concerning. So some of the developed countries, especially post-COVID, they've seen the debt levels balloon. In case of India also, the debt levels shot up post-COVID. But vis-a-vis the increase in debt levels, especially in case of developed countries, our debt levels are much more manageable than what we are seeing in case of developed countries. Having said so, I think in terms of emerging market peers, India still kind of stands out as one of those countries having a little bit of higher debt pressure. So it's all about whom are you comparing yourself with? Are you comparing yourself with developed economies? I guess there India stands out much more favorably. If you're comparing yourself with similar peers in the emerging market space, then I guess India probably is on the higher end of the debt spectrum. Now, is it concerning at an absolute level? Is the other question. Well, I guess India, fortunately, is blessed with a relatively higher profile of nominal GDP. And for debt sustainability, nominal GDP growth is absolutely important because you need to ensure that the economy grows at 10%, 11%, the least, to be able to service that debt. So India, even if you're assuming a 6.5% steady state real GDP growth and add about 4.5% of inflation, CPI, WPI combined, you land up somewhere close to 11% GDP. So that doesn't really let the problem go out of hand. You will still be able to consolidate debt. It's just that the initial shock that we received post-COVID, it will take us a little bit of while to get back to pre-COVID levels.
All right. And of course, the other question is on rural demand. Governor also hinting at the fact that rural demand is picking up. There is a pickup in the affordable market segment. High frequency indicators are not quite likely in line with what the governor is saying at the moment. In your assessment, what are you making of the consumption picture in India in this quarter?
So in this quarter, very difficult to say because I guess from an economic standpoint, we tend to take a much more holistic view. Focus more on the next 4 quarters or maybe the annual view.
Let's then talk about the overall financial year. Do you see demand pick up in rural economy? Because that remains a point of concern for a lot of economists and observers out there.
So the signals are mixed, I would say, at this point in time, because at one end you have still some of the scars from COVID playing out in case of the rural economy. You are also coming out from a very adverse, or maybe I would say not so very supportive monsoon backdrop. Last year we did not have a good monsoon in terms of its spread as well as its intensity. And yes, meanwhile the scars of COVID continue to play. So that is one part of the drawback. The supporting side of the picture is that the government spending, especially in case of rural area, has been much more productive, both through targeted programs as well as the overall quantum of spending. So on one side you have these headwinds, on the other side you have a little bit of cushion where the government is trying to preserve and provide. Now going forward, as far as the signals from interim budget, so the interim budget, you've got to keep in mind that it's interim. It has a very short shelf life, just about 3 to 4 months. But nevertheless, if we take that as a signal, then a couple of things we note. One is that the quantum of spending, especially directed towards rural, is normalizing. By normalizing, I mean that as a ratio to GDP, the rural spending is slowing down and getting back to its pre-COVID levels. The post-COVID, there was a shoot up in rural spending. Now it is getting scaled back. It's getting back to normal. So that is one. Number two is that the spending which is getting carried out currently is now being more chiseled and more focused. So you have more clarity on, let's say, something like a PM Awas Yojana, especially in case of Grameen. So they've got PM Awas Yojana, Grameen, which has got higher allocation and which seems to be the focus area for the government. Now, housing is one sector, if I can add, has tremendous amount of forward and backward linkages, which is true in case of rural as well as urban parts. So if the government is trying to pick up housing as one sector where they are going to focus on tremendously, I think it should be able to provide a decent amount of support.
Right.
And besides this, I think there is also continued support from the LPG scheme. There is also continued support from the free food grain distribution program. So while the quantum of spending is normalizing, there is now much more directed spending at chosen sectors or maybe with respect to chosen themes as far as the rural parts of the economy is concerned.
Okay.
So the overall guess would be that as we move forward, things should start improving on the rural front as well. And here again, the key assumption that we are making is that next year's monsoon is good because we are just coming out from a not so good monsoon scenario. Especially even in the current phase, the Rabi season, ongoing Rabi season, the monsoon hasn't been pretty adequate. So hopefully, if things turn out well on the weather front and with all these targeted measures from the government side, the rural part of the economy should also.
All right, Vivek Kumar, always a pleasure, sir. Thank you very much for taking time out and for speaking to us.
Thank you so much.
And now let's quickly dip into Congress President Mallikarjun Kharge is currently speaking to the media. Listen in to what he's saying.
इंपोर्ट करते हैं वो जहाज समंदर में रखते हैं टिल यहाँ के प्राइसेस राइज नहीं होते. जब प्राइसेस राइज होते हैं तब वो समंदर में से रहने से जहाज पोर्ट पे लाते हैं. पोर्ट पे इसे लाने के बाद ही उसको वो टैक्स लगेगा, वो लगेगा, ये लगेगा. इसीलिए वो भी काम वो करते हैं. यानी दे ट्रीट बिग जो जहाज होते हैं उनको एक गोडाउन के तरफ वो ट्रीट